Leading the way for me was Tesla, and the rest of my portfolio in the red. And when life hands me lemons, I add sugar and water, and then I sell it for a significant premium. Guys, what a week. Monday, the markets got wrecked. Big default in China. Maybe you heard about it. My portfolio was down about $40,000 to $45,000 on Monday. And then each day we just sort of like chugged along. Nothing to see here, nothing to see here, nothing to see here. By the close on Friday, we're up 0.75%, $9,500. That's like a $50,000, $60,000 swing over the course of the week, which was mostly an uphill battle the whole way. And I'll take what I can get, so I'm happy with that. The indices did fare better though. The NASDAQ here up 1.5%. The Dow and the S&P 500 both up 1.84% for last week. Even though the futures market did better than my portfolio, the chart almost looks exactly the same. So Monday, everyone got wrecked. And then the rest of the week, we're kind of fighting our way back to get into the green. Back to my portfolio, leading the way for me was Tesla, which is the only reason why I made it into the green. You can see it's up nearly 2%, $15,000, and the rest of my portfolio in the red. The way I look at my portfolio is each one of these categories is sort of like an investment idea or thesis. Tesla is its own category just because it's simply so large, currently making up 62% of this portfolio. If we pop open one of these sub-portfolios, we'll start with Fengi type stuff, can actually find some green inside of it. Even though the sub-portfolio is down, there are things that did well. Square, for one, up 2.5% for the week. SoFi did amazing, 17%, but it's such a small position, it really doesn't move the needle for me. Now, what did really bad this week were the Chinese stocks. Those got hit very hard. So Alibaba, NIO, JD, all down high to mid single digits. Chinese stocks have really gotten hit hard over the last several months. But this week in particular was bad on the back of the news we got on Evergrande. Evergrande? No. All right, so now we'll check out ETF Machine. ETF Machine was down the most, narrowly doing worse than unhinged dividends. For the most part, the worst of it is my ARK ETFs. ARK G, which was down 6.3% for the week. ARK ETFs, which had an amazing performance coming into the year, have really performed like under the weather. And this week has been no different. When you take a look under the hood, see what's inside of these ETFs, I think what we're seeing here is a lot of interest rate sensitivity. When interest rates go up, investors are less willing to pay up for future earnings. 10-year treasury is only at about like 1.4%, maybe a little above that right now. But it's not the amount of the rate. 1.4 is very low still. It's the rate and trajectory of the change that scares people. And a lot of that worry is manifested in the companies that are in these ARK ETF wrappers. All right, in my unhinged dividends pie, the only thing in the green here is Starbucks. Starbucks just by a hair, 0.5% up for the week. Just squeaking by there in the green. Starbucks, a lot of the growth story is wrapped in China. So it's a little peculiar that it's up, but I'll take it. Disney down 4%. Omega Health down 3%. But the biggest loser here is FedEx, down over 11%. Disney cited the Delta variant for production delays. We'll get more into that in a second. While FedEx reported higher labor and supply chain costs, which FedEx is saying contributed to a 10% increase in capital expenditures. They also estimated that the impact of the labor shortages cost them $450 million. In their earnings call this week, if you listen to it, how do I put this? They didn't inspire confidence. The good news for the economy is that demand isn't an issue, so that's good news. The silver lining, so to speak. All right, back to Disney. So for Disney, as much as the Delta variant is certainly impacting revenues for resorts, cruises, and the parks. Investors are really focused on what's happening with Disney Plus, Disney's streaming service. And Disney CEO Bob Chapek in a Q&A mentioned there will be production delays, which has investors worried that there might be pressure on subscription growth, which has become the most important metric for most investors, it seems. All right, now let's check the dividends, which was mostly flat, barely down. What really did well in here and almost got me into the green was EPR Properties and IIPR, which is Innovative Industrial Properties, up 5%. Starbucks is also in here, and I've got FedEx in here too. So a small bit of FedEx really weighing down this portfolio. Oh, and SPG did well too, 2%. SPG, EPR, and IIPR are all REITs. What really happened here, whether it was interest rates or some other factors, is REITs did well. It didn't really matter what the underlying company was. Money was shifting from one part of the market into this part of the market, and it did well this week. That's my simple take anyways. IIPR buys cannabis facilities from licensed growers and leases the property and equipment back to the cannabis producers. Providing capital to these companies helps the businesses grow in an environment where it's tough to raise capital because of the federal prohibition on their product. The current state of the regulatory environment means that these companies can't just go to a bank and get a business loan, which is a good thing for opportunistic companies like IIPR, which is essentially buying up the cannabis infrastructure and then leasing it back at rates that other REITs, real estate investment trust, could only dream about, right? IIPR has great balance sheets, particularly for a REIT. Operation cash flow is growing at an incredible rate. It's off the charts. Amazon would be jealous. Now, you do have to pay up for it. It trades at a healthy multiple, but I'm okay with the valuation here. I kind of like it. The total addressable market just seems huge. Penetration is still very low. They're very much ahead of their competitors, and their lead is probably insurmountable. And I think the returns from here can continue to be incredible. But, and it's a big but, there are no free lunches. And if legislation like the Safe Banking Act were to pass, then that would mean that there would be an influx of competition for IIPR. Now, in my opinion, the market would be so large and growing fast enough that I don't think it would slow down IIPR, or rather their ability to acquire more real estate, but it will have effect on the return that they are able to get for those properties, which will have an effect on how much investors are willing to pay up for those future returns. Caveats. Funny enough, the House passed this on 4/19 and it went to the Senate on 4/20. That's a nice touch. All right, last but not least, we're going to go down to the Lime hedge. This is where I'm investing most of my money right now. The idea is that I'm putting money to work in companies in a section of the market that looks entirely different than the rest of my portfolio. My portfolio is very much overweight mega cap tech growth. And in this part of the pie, we're buying, for the most part, broad spectrum index funds with a bias towards international and small cap companies. Up here at the top, Deep provides exposure to deep value microcaps. Certainly none of the companies inside of this ETF look like anything else in my portfolio. And in my Robinhood account, I'm invested in ZIG, Z-I-G, which is a sister ETF to Deep. It's run by the same manager. The way ZIG works, it's long the cheapest stuff in the market and it's short the most expensive stuff in the market. So very much the opposite of my portfolio. The difference between it and Deep is microcap and you can't short microcaps. So Deep is long only, ZIG is a long short fund. Good luck shorting microcaps. All right, so VTI here represents the total stock market index. We'll skip over up IPOF and IPOD for a minute here. VWO and VGK are emerging markets and European markets. Skip over BABA for a second here. VBK is small cap growth. These are all low cost indexes, well, except for Deep and ZIG, which are actively traded and thus a higher expense ratio. All right, so why do I have these other positions? What's up with up? What's up with up? IPOF, IPOD, and BABA. Why are they in here? These companies kind of break away from the thought process and the goal of this specific sub-portfolio. So why is it in there? Well, I have granted myself authority on taking opportunity when I see one available. I'm the chief investment officer of this lemonade stand, and when life hands me lemons, I add sugar and water. and then I sell it for a significant premium. Likewise, when life hands you a deflated SPAC market or Chinese regulatory fear, I buy the beaten up securities. I hold them through the storm, and I wait for the rainbow at the end of the tunnel. I hope that analogy makes sense, because I'm not going to do another one. Later this week, maybe Wednesday, I'm going to try to put out a video on why I think these companies are undervalued and there's good opportunity there. Scary, but good opportunity. But guys, if you've made it this far, hit the like button, subscribe. I'm doing these updates every week. My name is Nick. This is My Lemonade Stand. Now get the hell out of here.